Welcome to The Sleeping Economist, where we explore the economic stories that shaped our world while most of us weren't paying attention. Today, we're diving into one of the most important financial events of the 21st century, a story that reveals how Wall Street really works when no one's watching. In 2007, while Goldman Sachs was selling mortgage securities to pension funds, insurance companies, and foreign banks, calling them solid investments, they were simultaneously betting $13 billion that these same products would collapse. When the housing market crashed, Goldman made $4 billion in profits while their clients lost hundreds of billions. This isn't speculation. It's all documented in congressional hearings, SEC investigations, and Goldman's own internal emails. By the end of this video, you'll understand how the 2008 financial crisis wasn't just about risky mortgages or greedy homebuyers. You'll see how sophisticated financial institutions created a system where they could profit from their clients' losses, and why understanding this story is crucial for anyone who wants to understand how modern finance really works. But first, please take a moment to like this video, subscribe to the channel, and drop a comment to let me know which economic or financial story you slept through and missed. I will do my best to feature it on this channel. Chapter 1: The Mortgage Securitization Machine. To understand what Goldman Sachs did, you need to understand how the mortgage industry was transformed in the decades leading up to 2008. This transformation is one of the most significant changes in American finance, yet most people have never heard the full story. Traditionally, when you got a mortgage to buy a house, your local bank would keep that loan on their books for the entire 30-year term. They had every incentive to make sure you could actually pay it back, because if you defaulted, they lost money. This system worked for decades and kept mortgage lending relatively conservative. But starting in the 1970s and accelerating through the 1990s, Wall Street developed a new model called securitization. Here's how it worked. Instead of keeping your mortgage, your local bank would sell it to a large investment bank like Goldman Sachs. Goldman would then bundle your mortgage with thousands of others and create what's called a mortgage-backed security. Think of it this way. Instead of owning one mortgage that pays you back over 30 years, investors could now buy a slice of thousands of mortgages bundled together. If most homeowners paid their mortgages, investors made money. If many defaulted, investors lost money. The key insight was that by bundling mortgages together, you could supposedly reduce risk through diversification. Goldman Sachs became masters of this process. Between 2004 and 2007, they securitized over $135 billion worth of mortgages. But they didn't stop there. They created increasingly complex products called collateralized debt obligations, or CDOs. These were bundles of mortgage-backed securities bundled together again. Essentially, securities made from other securities. Then Goldman created synthetic CDOs, financial instruments that didn't even contain actual mortgages, but were instead bets on whether other mortgage securities would succeed or fail. By 2007, the total value of these synthetic products was larger than the entire U.S. mortgage market. This system created something economists call a moral hazard problem. The people making the initial lending decisions, your local bank, no longer bore the risk of those decisions. They could make risky loans and immediately sell them to Wall Street. Meanwhile, the people buying these bundled securities often had no idea what was actually inside them. Goldman Sachs wasn't just participating in this system, they were one of its primary architects. And by 2006, they started to see serious problems on the horizon. Chapter 2: The Warning Signs. December 2006 marked a turning point that most people missed at the time. While the rest of Wall Street was still celebrating record profits from the mortgage boom, Goldman Sachs's own risk management team was raising red flags. Internal Goldman presentations from this period show they were tracking several troubling trends. First, the quality of mortgages being originated was deteriorating rapidly. Many loans were being made with no verification of income, employment, or assets. These became known as ninja loans. Second, home price appreciation was slowing in key markets across the country. Third, early payment defaults, where borrowers stopped paying within the first few months, were increasing. Most significantly, Goldman's quantitative analysts were running stress tests that showed what would happen if home prices stopped rising, or worse, started falling. The results were alarming. Many of the mortgage securities they had created and sold would lose substantial value. Some would become worthless. Here's what makes this story so important. Goldman didn't just see these warning signs, they acted on them. But instead of warning their clients or slowing down their mortgage business, they made a calculated decision to profit from the coming collapse while continuing to sell mortgage products to unsuspecting investors. In early 2007, Goldman's mortgage trading desk began building what they internally called the Big Short. They started betting against the very mortgage securities they were still creating and selling. This wasn't a small hedge to protect their existing positions. Internal documents show they accumulated net short positions worth over $13 billion. The timing is crucial here. While Goldman was building these massive bets against the mortgage market, they were simultaneously ramping up their sales efforts to institutional clients. Sales presentations from this period show Goldman marketing mortgage securities as offering attractive risk-adjusted returns, backed by high-quality underlying assets. One Goldman salesman's email from February 2007 perfectly captures this contradiction. While pitching a CDO to a client, he wrote, "This is a great opportunity to get involved in the subprime market." That same week, Goldman's internal risk reports showed they were net short $6 billion in subprime mortgages. Chapter 3. The Double Game. The most revealing example of Goldman's strategy involves a synthetic CDO called Abacus 2007 AC1. This deal, more than any other, demonstrates how Goldman structured transactions to benefit themselves at their clients' expense. In early 2007, Goldman was approached by hedge fund manager John Paulson. Paulson had studied the mortgage market extensively and concluded it was headed for collapse. He wanted to bet against mortgage securities, but he needed someone to create the instruments that would allow him to do so. Goldman agreed to help, but with a twist. They would create a synthetic CDO, essentially a collection of bets on existing mortgage securities, and Paulson would help select which securities to include. Naturally, Paulson chose securities he believed were most likely to fail. Goldman then marketed this CDO to institutional investors. The key clients were European banks, IKB Deutsche Industrie Bank and ABN AMRO. Goldman's marketing materials described Abacus as offering exposure to carefully selected mortgage securities with attractive risk characteristics. What Goldman didn't tell these investors was that the securities had been carefully selected by someone who was betting they would fail. It was like selling someone a used car that had been specifically chosen by someone betting it would break down, without mentioning that detail. When Abacus inevitably collapsed, the results were exactly what you'd expect. Paulson made approximately $1 billion from his bet against it. The European banks lost nearly $1 billion. Goldman collected fees from all sides, from creating the CDO, from helping Paulson structure his bet, and from selling pieces to the banks. But Abacus wasn't unique. Congressional investigations later revealed that Goldman created at least 25 similar synthetic CDOs between 2004 and 2007, with a total value exceeding $11 billion. In many cases, Goldman helped hedge funds select securities for these CDOs specifically because those hedge funds were betting against them. Chapter 4. The Internal Communications. The most damaging evidence of Goldman's awareness came from their own internal emails, revealed during congressional investigations. These communications show that Goldman employees understood exactly what they were doing and had no illusions about the quality of products they were selling. In January 2007, Fabrice Tourre, a Goldman vice president who would later become the public face of the firm's mortgage practices, sent an email to a friend describing the broader economic situation. He wrote, "More and more leverage in the system. The whole building is about to collapse any time now. The only potential survivor, the fabulous Fab, as he will be well positioned, like he was in 2004, to make some serious money off of the collapse." This email is significant because it shows Goldman employees understood they weren't just making smart trades, they were positioning themselves to profit from broader economic destruction that would affect millions of people. Another email became infamous during congressional hearings. In June 2007, Tom Montag, a Goldman executive, sent a message about a CDO called Timberwolf that Goldman had sold to clients. He wrote, "Boy, that Timberwolf was one shitty deal." The timing of this email is crucial. The same day Montag described Timberwolf as a shitty deal, Goldman was still marketing it to potential investors. Sales materials from that day described Timberwolf as offering attractive returns, backed by high-quality assets. Perhaps most revealing was an email chain from July 2007, as Goldman was preparing earnings reports that would show massive profits from their mortgage bets. CFO David Viniar wrote to colleagues, "Tells you what might be happening to people who don't have the Big Short." This communication shows Goldman executives understood that their profits were coming directly at the expense of other financial institutions and investors who had bought Goldman-created mortgage securities. Chapter 5. The Collapse and the Profits. When the mortgage market finally collapsed in late 2007 and 2008, the destruction was exactly what Goldman had anticipated. The statistics are staggering. Home prices fell by an average of 30% nationally, with some markets seeing declines of 50% or more. Foreclosure filings increased by 81% in 2008 alone. Major financial institutions began failing. Bear Stearns, which had been heavily involved in mortgage securities, collapsed in March 2008 and had to be rescued in a government-facilitated sale to J.P. Morgan Chase. Lehman Brothers, another major player in mortgage securities, filed for bankruptcy in September 2008. AIG, the insurance giant that had written credit default swaps on mortgage securities, required a $182 billion government bailout. But Goldman Sachs was different. While their competitors were reporting massive losses, Goldman announced substantial profits. In 2007, they made approximately $4 billion from their mortgage-related short positions. Their stock price held up better than any other major investment bank during the initial phase of the crisis. This wasn't luck or superior risk management in the traditional sense. This was the result of a calculated strategy to profit from the destruction of the very market they had helped create. While pension funds lost billions, while foreign banks required government bailouts, while millions of Americans lost their homes, Goldman Sachs was collecting profits from betting against the mortgage securities they had sold to these very institutions. The irony deepened when Goldman received $10 billion in TARP funds as part of the government's bank bailout program. They were being rescued with taxpayer money while having profited from the crisis that necessitated those rescues. Even more problematically, Goldman used government bailout funds to pay employee bonuses. In 2008 and 2009, despite receiving taxpayer assistance, Goldman paid out over $16 billion in compensation. Lloyd Blankfein, Goldman's CEO during this period, received a $68 million bonus in 2007, the year they made billions betting against their own clients. Chapter 6. The congressional reckoning. By 2010, evidence of Goldman's practices had become overwhelming. The Senate Permanent Subcommittee on Investigations, led by Senator Carl Levin, launched a comprehensive investigation into Goldman's mortgage-related activities. The April 2010 hearing became one of the most watched congressional hearings in years. Senator Levin, armed with Goldman's own internal emails and trading records, questioned company executives for over 10 hours. The hearing revealed not just what Goldman had done, but their attitude about it. The most memorable exchange occurred when Senator Levin repeatedly quoted the "shitty deal" email to Goldman executives, asking how they could sell products they privately described in such terms. The Goldman executives' responses revealed their fundamental perspective on their client relationships. Lloyd Blankfein, Goldman's CEO, offered a defense that became a textbook example of how Wall Street views its role. He argued that Goldman was simply acting as a market maker, providing liquidity to clients who wanted to buy mortgage securities. He claimed Goldman had no obligation to share their market views with clients or to act in their clients' best interests. "We didn't have a duty to tell our clients what our position was," Blankfein testified. "We're a market maker. We make markets and securities." When pressed by Senator Levin about whether Goldman had any responsibility to its clients beyond simply executing trades, Blankfein's responses revealed a view of finance that many found disturbing. In Goldman's view, they were not advisors helping clients make good decisions. They were counterparties in transactions, and if they could make money when their clients lost money, that was simply how markets worked. This exchange illuminated a fundamental issue in modern finance, the blurred line between advisory relationships and transactional relationships. Many of Goldman's clients believed they were getting advice from a trusted financial institution. Goldman believed they were simply executing trades with sophisticated counterparties who should understand the risks. Chapter 7. the aftermath, and consequences. Despite overwhelming evidence of problematic behavior, the consequences for Goldman were relatively modest. The company paid a $550 million fine to the SEC, significant in absolute terms, but small compared to their $4 billion in profits from the mortgage crisis. More importantly, no Goldman executives faced criminal charges. The Department of Justice investigated but ultimately declined to prosecute, citing the difficulty of proving criminal intent and the complexity of the financial instruments involved. Only one Goldman employee, Fabrice Tourre, faced individual civil charges. He was found liable for securities fraud in 2013, but received no jail time and was banned from working in the securities industry, a penalty that many viewed as insufficient given the scale of the harm caused. The broader implications of the Goldman case extend far beyond one firm's behavior. The episode revealed fundamental problems with how Wall Street operates and how financial regulation works in practice. First, it highlighted the problem of conflicts of interest in modern finance. When financial institutions act as both advisors and counterparties, they face inherent conflicts between their clients' interests and their own profits. Goldman's mortgage activities showed how these conflicts can play out in practice. Second, it demonstrated the limits of financial regulation. Despite extensive rules governing securities markets, Goldman was able to structure transactions that technically complied with regulations while violating the spirit of fair dealing that markets depend on. Third, it showed how the complexity of modern financial instruments can be used to obscure risk and responsibility. Many of Goldman's clients were sophisticated institutions, but even they struggled to understand the true nature of the products they were buying. Afterward, lessons for today. The Goldman Sachs mortgage story offers several important lessons for understanding modern finance and economics. First, it illustrates how financial innovation can create systemic risk. The securitization of mortgages was originally intended to spread risk more broadly and make the financial system more stable. Instead, it created new forms of risk and new opportunities for conflicts of interest. Second, it shows how information asymmetries work in practice. Goldman's advantage wasn't just that they were smarter or better at analysis, it was that they had access to information about mortgage quality and market conditions that their clients didn't have, and they used that information to profit at their clients' expense. Third, it demonstrates how individual rational behavior can create collectively irrational outcomes. From Goldman's perspective, betting against mortgage securities while selling them to clients made perfect sense. But this behavior contributed to a financial crisis that ultimately required government intervention and caused enormous economic damage. Today, many of the structural problems that enabled Goldman's behavior remain unchanged. The largest banks are larger than they were before the 2008 crisis. The conflicts of interest between advisory and trading activities still exist. The complexity of financial instruments continues to grow. Understanding the Goldman Sachs story isn't just about understanding the past, it's about understanding how modern finance works and why financial crises continue to occur despite extensive regulation and oversight. The next time you hear about complex financial instruments, conflicts of interest on Wall Street, or debates about banking regulation, remember the Goldman Sachs mortgage story. It's a perfect case study in how sophisticated financial institutions can profit from activities that ultimately destabilize the broader economy. Most importantly, this story reminds us that in finance, as in any other field, the interests of service providers and their clients don't always align. Understanding this basic fact is crucial for anyone trying to navigate the modern economy, whether as an individual investor, a business owner, or simply as a citizen trying to understand how our economic system really works. The sleeping economist in all of us needs to wake up and pay attention to these dynamics because they shape everything from mortgage rates to pension fund returns to the stability of the global financial system. The Goldman Sachs story shows us what can happen when we're not watching and why we need to keep our eyes open. Thank you for watching our economical story. We hope it has opened your eyes somewhat. Remember to give this video a like and subscribe to the channel so you do not miss our next financial tale.